Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, welcome back to YouTube. It's time to look at Bitcoin. It's been a pretty wild couple of days. Now, first things first, got a really sore throat today, so if I'm coughing and clearing my throat and spluttering a lot, apologies in advance. I will try and pause the video as and when it creeps up on me, but sometimes it's a spontaneous thing. So, it's been a while since I've updated you guys, actually. I think the last YouTube video I did for Bitcoin was... yeah, the last one we did was January 10th, which was this one. Bitcoin probability points to a bear market. And then the one prior to that was December 3rd, which was a Bitcoin bear market or something different. Now that something different which featured in this episode back in December is still in play to this day, and we'll cover that in the Elliott Wave section of the video. Yeah, so December and January. Where we started talking about the likelihood of a bear market. So it has been a while, so we'll go by the numbers today and we'll go through absolutely everything. Now I'm also going to put in the description box of this video a link to this video called Bitcoin Primer and the 4-year cycle. Now this was introduced, or I published this on the 10th of January, I think it was around the 10th of January 2025. May have been a bit earlier, but it was the early January last year, not this year, so over a year ago. And this predicted the cycle end for October 2025, and it talked you through about the long-term count, how a 4-year cycle works, and everything you need to know to understand Bitcoin from a technical point of view. Okay, if you're new, you've just started investing, or maybe you just brought the recent high and you're worrying and you're panicking, or you want to get in now and you don't know what to do, go and watch this. It will help soothe you and calm you down. We have to, all those of us who are more experienced, collectively make an effort to do that during this period, because we've all been there before, guys. This is the end of my 3rd rodeo, and I will be now transitioning to my 4th cycle by the time this one's over. So I've gained some experience during that time. Now, all of you who are listening, raise your hands if you've ever done something stupid like buy the top of an asset before. Okay. Both my hands are in the air. Been there, done that. Right? Haven't done it this time, didn't do it the last cycle, did it like crazy in the 2018 cycle. Okay, and I've been investing a lot longer than I've been in crypto, and I still made that error. Okay, so we're human beings, we make mistakes, we have to forgive ourselves first, so don't beat yourself up. The great news is you will be profitable again, and you've got an opportunity to average down your price over the coming year. Now, on that note, I want to have a quick talk about the 4-year cycle in general, where we're going from here, and what I think is happening. And I want to start with a statement, a famous quote from Mark Twain, who said, "It's not what you don't know that ruins you. It's what you know for certain that just ain't so." That's a reference to hubris. Now, if you don't know what hubris means, it means when you believe you are right at the cost of all others. So you believe that I am right, nothing else can convince me otherwise. It is definitely going to work out this way. That's hubris. Now, what we've seen in this cycle, in my opinion, is a almost absurd willingness to throw the baby out with the bathwater. The amount of poo-pooing of the 4-year cycle that's gone on during this bull market has been truly historic, in my opinion. And it doesn't matter what the macro reason is. Lots of macro reasons. Oh, institutional adoption means the 4-year cycle is useless. Oh, the debt's being rolled over at a later date means the 4-year cycle is useless. Oh, interest rates were up for longer. The business cycle is suppressed. Bullshit. Bullshit, nonsense, stupid, fucking noise. Okay? Right. We don't ask complex questions for simple problems, and we don't provide complex answers for simple questions. Okay? What we have here is a playbook which, regardless of how many people hate it, continues to play out like clockwork. Okay? In order to get our predicted date of October, which you saw from the video back in January 25, and I predicted it long before then, back in 23. Oh, sorry, back in 24, and I think late 23 when we were on our way up out of the last bear market, where if everything played out, where we'd end up. We took a 1,064-day bull market, then it was projected forward, and we got a 1,064-day bull market, projected forward from the last bear market low, 1,064 days, and we predicted the highs within 2 weeks. Now, bit of clarity, because I've already had a couple of angry emails from people who refuse to take accountability for their own decisions because they're not grown-ups. I was extremely bullish during this rally, right? And I had an extremely bullish count. Strangely enough, though, when indicators started to roll over and the probabilities literally shifted and changed to something else, I pivoted, changed my analysis to suit the new probabilities, informed everybody about it, put videos out about it months in advance. So I'm sorry that you didn't like me being bullish during this phase, but I was right to be bullish during this phase. My expectations for much higher future pricing during this bullish phase were wrong. Okay? And I will hold my hands up and admit that, but I didn't stick to my guns. I pivoted and changed my mind when I saw the evidence to change my mind. But the probability, the possibility and probable outcome that the market would top based on the 4-year cycle was always there and always present in our analysis, and it just so happens to have been turned out to be true. Now there's going to be a lot of bullshit excuses being made as well if things do change from here, so let me explain. We are in a bear market. That is the definition you need to understand. Before anything else, don't let anyone else talk you out of that. Okay? Now be careful, because a lot of idiots are going to tell you that it now has to be a year. The hubris I was referring to in denial of the 4-year cycle could be the same hubris in insisting upon it being perfect. I'm not going to do either. Try and keep an open mind. It could take a year to correct. It could be done now. Right, but the one thing it most certainly 100% and definitely is a bear market. So let me show you what I mean. Right, a drawdown thus far of 52.49%. This is greater, if we just come off of linear for a moment, come off of the vlog for the moment, this pullback is greater than any of the pullbacks within the prior bullish trend to the all-time high from the bottom of the last bear market to the peak of the one just come. Right, it is significantly greater. It breaks the upward trend, the upward sequence of higher high, higher low, higher high, higher low. Here's the last one, higher high, higher low. Trend broken. This is a breach of the bullish trend. It is a significant pullback greater than any of the pullbacks within that bullish trend. It is a free wave structure like a sharp featuring no new price extreme, and it elicited a crossover on the MACD on the monthly time frame here of the average through the signal. This signal on the MACD has occurred in every single bull market top since the inception of this asset being tradable. Average for the signal, expanding histogram below. Average for the signal 2021, expanding histogram below. Average for the signal line 2018, expanding histogram below. Average for the signal line 2014, expanding histogram below. Every single time this signal has called it, and when we spotted this signal we informed ourselves about it. Patrons were first given notice of it, and then we discussed all the possibilities, and then later, a few weeks later, it was put onto YouTube back in December and then reaffirmed in January. We do not ignore this. That is a confirmation of the bear market. Breach of trend, severe pullback, sharp structure, MACD crossover. Now the reason I'm telling you this is if we suddenly reverse and go higher to new highs, there's going to be a lot of bullshit being spoken. People saying, "Oh, we were never in a proper bear market because it didn't last a year. It was over quicker. It was smaller. It was shallower." Okay, it was a bear market, 100%. Okay. Now, on the note of bull markets and bear markets, we know that if the 4-year cycle plays out as expected, we will bottom in October this year. If it doesn't, we may bottom sooner. The one feature of these bear markets, which I wish to discuss, there's a couple of features actually, is first of all the level of price correction. If we have a shallower correction, that would be perfectly in line with all the prior bear markets anyway. So we have seen extremes of 93.6% decline in price to 86.4 to 84.1 to 77, the last one was the least aggressive, to so far 55, maybe 60, maybe 70, but if the sequence of smaller bear markets continues, this one will be shallower. But don't allow that to fool you into thinking it wasn't a bear market. Okay, it most definitely is. Then we've got the corrective form. The corrective form so far is breaking down as a sharp structure with no new price extreme above the high. Same here, same here, Same here. This sequence fits our primary long-term count. We have overlapping corrective waves. This low overlaps this high. This low overlaps this high. Sharp structure with a severe decline. Sharp structure with a severe decline. Sharp structure so far with a severe decline. This fits our primary count of 1, 2, 1, 2, 1, 2 wave free extension. Early adoption model of a major new asset class. Right? People say 15 years, new adoption early. Yeah. Well, how long has gold been trading for, mate? Longer than you've been around, longer than your grandparents have been around. It was around before them, and it's outlived them. So, yes, it's early days still. And even assets such as gold and silver, which I've recently called the tops for in a recent video, I still believe we're in a secular bull market. But a secular bull market, just like the one we're here in Bitcoin, this is a massive secular bull market of higher highs and higher lows over time, will be periodically interrupted by cyclical bear markets. That's what we've been experiencing, and that is what we are experiencing currently. So, a quick recap. The 4-year cycle continues to play out like clockwork regardless of all of its naysayers. Bull market and bear markets continue to play out as predicted. If this one follows suit, it will bottom October this year. However, if it doesn't bottom October this year, later or sooner, and continues to new all-time highs from now or from later, but does not reach this time target, that is irrelevant to whether or not it was a bear market. I've proven technically that it is. Okay, this goes back to the hubris I was talking about earlier. Don't listen to the greatest, newest narrative dismissing a proven idea. Don't embrace proven idea to the exclusion of all else. Try and keep an open mind, and you will do a lot better. Right then, so there's your 4-year cycles. There's the expected bottom. Brilliant. So now the next thing I want to move on to, in case you're not familiar with it, is we express these as seasons, right? So we have a spring, which is the period we come out of the previous bear market. We have a summer where we make new price extremes above the prior cycle, and then we have an autumn where we top that current cycle. Then we have a winter. We are in the winter, and if all things play out, it will bottom October this year. The next thing I want to discuss is the halving data. Another thing which has been ignored and poo-pooed and dismissed as irrelevant. It depends how you want to talk about it. If you insist upon that measuring from halving to halving is some kind of cyclical pattern, you are making a mistake. Market cycles are measured from lows to lows. That's the entire period it takes to go through the entire cycle. From the lowest bear market all the way up to euphoria, all the way back again. You can measure from lows to highs if you want. You can make multiple cycle analysis if you wish. The 4-year cycle, when I'm referring to it, is referring from low to low, and that's the one which has been playing out consistently over time. Now, the halving, I'm not interested in cycle behaviour. I'm interested in price action. I'm interested in price behaviour. So the trend that I've seen, that we all are aware of, is that the post-halving move elicits the greatest returns of the entire bull phase, the entire bull market. So if we look at the bull market which peaked back in November 2013, we saw that 98.96% of the total price move, I'm not talking 98% price move, that was a 9,688 price move post-halving, but 98.96% of the entire bull market occurred post-halving. In the next cycle peak that we saw in December 2017, 97.4% of the total bull market occurred post-halving. In the cycle after that, 91.6% of the total price move was after the halving, post-halving. And in this cycle, only 57.6% of total price move was after the halving. Right there is your explanation for all the BS theories, all the bullshit theories. That, it has to go on for longer because we didn't hit price targets. It has to go on for longer because of the debt. It has to go on longer because of this, that and the other. That's why. Because it didn't return what our hubris was insisting that it did. It has to return 90%. I said maybe between 70 and 80, maybe a little higher. Maybe. If we keep this trend. We were all disappointed. We didn't get those big returns. The whole bull market, only 57.6% of it occurred post-halving, which is a significant decline from prior halving events. So, what can we assume? Well, we can prove that the trend of greater returns post-halving is still intact. 57.646% is still greater than 49.99 recurring. Okay, so that trend's still intact. However, the total return in comparison to prior post-halving cycles was greatly reduced. So an interesting feature we will observe out into the future will be, will the next cycle's pre-halving returns actually exceed the post-halving returns? That could be a shift in behaviour. Will it be above 50% with the post-halving retaining most of the gains? Will it become completely irrelevant? All of those things we will have to wait and see. But that's what I find interesting about the data. That was a consistent, repeatable thing until now. The trend is the same, greater post-halving, but the amount is significantly different. So I can go forward in time expecting less of the price action post-halving than I have before. That could be wrong, but at least it's an observation I can make. So there's an interesting bit about the halving data. So we've covered halving data and we've covered the cycle. So let's now do some classical analysis. Now, I mentioned earlier the MACD crossover. This is absolutely essential to understand. I've already shown you how when the average line crosses through a signal line and the histogram expands below the zero bound and that bearish momentum starts to build up, this has played out every single time without fail that there's been a bear market. That cyclical behaviour has once again been strengthened as a pattern. Now, the time at which the histogram expands before it starts to wane and contract back towards green varies. So far we've had 1, 2, 3, 4 months of expanding histogram. In the prior cycle, during the expansion phase of the bear market, we saw 1, 2, 3, 4, 5, 6, 7, 8 bars. The one prior to that, we saw 1, 2, 3, 4, 5, 6, 7, 8 bars again. And the one prior to that saw 1, 2, 3, 4, 5, 6 bars. So the first bear market we saw back here from 2013 onwards, right, saw a quicker rush down and a longer recovery. The next one saw a quick rush down, a slower grind down and a quicker recovery with COVID in between. The last one, what did we get on the way out? 1, 2, 3, 4, 5, 6, 7, 8. A perfect 50-50. 8 months down, 8 months up. Not referring to price, guys. Talking about the histogram here on the MACD. Maybe we get 8 down and 8 back. Maybe we get 4 down and 4 back. Maybe we get something different this time. But the signal remains absolute. Okay. Now regarding the monthly exponential moving averages, the 10 is yellow, 20 is blue, 60 is orange. Throughout the bear market corrections we've seen in the past, the price breaks down to the 20 exponential moving average with a wick through it. It bodies above it most times. It moves sideways along the 20, sometimes pivoting, sometimes piercing the 10 before crashing down. So we came down to the 20, bodied above it, moved sideways, crashed down. If we look back at the last bear market, we moved down to the 20, moved back up to the 10, we body above the 20, we crashed down. We move back to the next bear market, we crashed down to the 20, we moved sideways, pierced the 10, crashed back down. Move back to the last of the prior bear market, down to the 20, body above it, up above the 10 this time, crash down. That's what we've done. We've come down to the 20 sideways and crashed down. So we've done technically a similar pattern, just in a compressed time frame thus far. We don't know if it's going to get bigger though yet, do we? Can't see into the future. Right, sometimes we wick to the 60, like we did right back here in 2015. Sometimes we wick through it, like we did here in 2018. Sometimes we trade below it, like we did here. And sometimes we may come deeper or we may stop exactly on it. The 60 on the monthly coincides with the 250 on the weekly. This is why I have them set up the way I do. Okay, so we've pierced the 250 weekly exponential moving average. We traded below it during the last bear market. We're at a major support level as well. So if I had to point out the major support here, I would say we've got the monthly close, which we should pay attention to. Monthly open and close of the last bullish cycle. So this is these two candles here. So go straight across the top. and we'll put in. Right, we did this for the prior cycle as well. Ah, damn it. Major monthly level. Right there. I'll change that to yellow as well. We came straight back to the 60 monthly moving average. We came straight back to that monthly level, which is major horizontal support across these two highs. And we came straight back into this major demand zone here. Okay, we can see that clearly. So we've come to the perfect place to bounce. Perfect place to put in a low. It could be the perfect place to bottom, but it's the perfect area for a low. Now that doesn't mean it's happened already. We could glide a little bit lower. We could strangle out some bullish divergence across those lows before we bottom. But whatever it is, a temporary low at least is coming, if not already here. Okay, and that's a major support level. Now if we move back to the weekly time frame and we look at the indicators again, we can see that this collapse down into the lows was heralded by multiple weeks of divergence. So from the highs of December 2024 through to the highs of July 25, we saw bearish divergence between the MACD, the RSI, and price, which went higher. We then saw double divergence play out from the highs of August 25 into the highs of September 25. So here to here, and we saw the same play out in the RSI and the MACD as well. So we had double divergence playing out over the weekly time frame, which led to this collapse in price that we've just witnessed. Now, one of the things I will point to that is a little peculiar about the price behaviour, given the sudden violence we've witnessed, is the extreme oversold conditions we've witnessed on the weekly time frame. Now, these kind of oversold conditions on the weekly time frame have been synonymous with finding market lows in the prior cycle bottoms. Now, the last one was a slight exception because it produced clear weekly bullish divergence from June of 22 into November-December 22. The RSI went from extreme oversold conditions here back into just oversold conditions here, while the price went lower. July down to December in Bitcoin was lower pricing, its higher lows in RSI. All the other major lows, such as the one in 2018, such as the one back here in 2015, they mark the actual low. The last cycle was different with strong bullish divergence. Right, this cycle could elicit the same bullish divergence, so price may go from the 60,000 it reached down to maybe 40,000 in a few months' time after a correction during the summer, while the RSI on the weekly time frame picks up a higher low. That's possible, we get that bullish divergence again, or we just come down lower. Either way, we've reached these oversold conditions on the weekly time frame significantly earlier than we have at any other period in any other prior bear market, suggesting that price is just extremely bearish overall. Which isn't necessarily a bad sign. It could just be that we weren't as euphoric. We didn't climb to as higher peaks in the RSI, and therefore getting down to the troughs is a lot easier. So it may also mean a shorter cycle. That's possible, or it may just mean greater extremes. Only time will tell. Either way, a bargain at this price, I feel. So there we go. That's the classical analysis. I don't think there's much else I really need to touch on in the meantime. So now we'll look at the long-term Elliott Wave count. So we'll bring up the primary count. So, as I previously mentioned, all of the prior structures in the long-term secular bull market that I believe we're in have elicited severe corrections of between 90 and 80%. This one 77, this one 84, this one 55 so much. All deep corrections, all sharp structures, and in the case of this so-called intermediate wave degree, primary degree and cycle degree, all overlapping one another. This is absolutely typical early market adoption extension behavior. We've seen it in mega caps like Apple going back decades. We've seen it recently play out at smaller wave degrees in gold and silver after generational periods of time. So it's never too early, is my point. So the count is as thus then. 1 and 2 super cycle degree, then 1 into 2 at cycle degree, then 1 into 2 at primary degree, and now we're into a new bear market, peaking the 1 at intermediate degree into the 2 at intermediate degree. We anticipate that each correction will be subsequently smaller than its prior one. The time frames have all been 1 year. That may change. As these wave degrees continue to get smaller, the argument for them getting shorter in duration increases in probability, but it has to be proven. So we can only know that historically when we look back. But that is the major count. Now, the way we get down from the current high is up for debate, and that's what we're going to look at next. We're going to look at the shorter term Elliott Wave picture, and I believe probably offers, a very simple way of looking at it. Now that the price is broken down, it's done me a lot of favours in terms of simplifying things. Why I've left it a little while to update you, really. So let's have a look at these counts then, shall we? The primary count, please bear in mind that the primary count does not mean it's correct. Okay, we are talking about probabilities. So once again, if this turns out to be wrong, I don't want to hear angry. Well, if you say, I'm going to get angry emails either way and angry comments. But either way, you said we were definitely coming down into the end of the year, and I should have brought and I didn't, and it's your fault. You are responsible for your own actions. Okay, the primary count is based on the confluent factors combined. So when I look at the price action, I look at support levels, I look at the moving averages, I look at the MACD and its duration and how it plays out. I look at the 4-year cycle, I look at all the signs I see at the moment, and I see the A wave down. The initial shock complete. 5 waves down. We will then come up in a B. This will be the bullshit phase. Just like we went through denial recently before crashing down, this will be the next denial phase. And you will have all these silly arguments come out here. See, it is an extended cycle. It is going to be a bullish year 2026. It is because of the debt. It is because of the business cycle. It is because of all this. And it's actually just a B wave. It comes to a lower high, grabs a whole bunch of liquidity, people piling in, and comes over and smashes them all in the arse. Right, down into the sea. Right, that would be absolute typical behaviour, completely normal for Bitcoin. Now, so far, we can see, come down to the daily time frame, we have crossed over the average. We have crossed over the def. We had the def cross here, 60 through the 250, synonymous with finding a low. It was a low. I always say low and never bottom because it's often temporary, as it was in this case. All pointing lower now. The way we get down in this count on the 8 hour, I'll show you. An opportunity to teach a little bit of Elliott Wave here as well. We come down in 5 waves. 1, 2, 3, 4, 5. I've put 2 trend lines around it to suggest that it's what we call an expanding wedge, known as an expanding diagonal in Elliott Wave. Amateurs who don't know Elliott Wave would call it a wedge, same as they call a rising descending triangle, or they call it a rising wedge. They don't know the proper term and they don't understand why it's happening, but they recognise the pattern. So that's the pattern that's playing out here, an expanding leading diagonal into an A. So the rules for an expanding diagonal, okay, they used to be, bit of history, they used to be that the 4 and a 1 had to cross over, and that we had a structure which created an expanding wedge, which is what we've got here. So I'm going to show you the example. And the rules were very, very strict, but they've now changed. The rules were that the wave 3 had to be longer than the wave 1. The wave 4 had to be deeper than the wave 2. The wave 4 had to transgress upon the price range of wave 1, in other words, enter where the wave 1 finished. And the wave 5 had to be longer than the wave 3. The new rules, as of the latest edition of Elliott Wave, are that the wave 4 does not have to transgress into wave 1 territory. Okay, the wave 3 does not have to be longer than the wave 1. They're the 2 changes. But the 2 rules which are absolutely still in play are that the 4 has to be deeper than the 2 and that the 5 has to be longer than the 3. I would insist upon the structure being the same as well. It has to be an expanding wedge in order to be an expanding diagonal. So, when we look at this move down of 5 waves, 1, 2, 3, 4, 5, we have a beautiful wedge. The 4 is deeper than the 2. Check. The 4 does not transgress upon the 1. Not a problem now. The 5 has to be longer than the 3. The target for the wave 5 to go beyond the length of the 3 projected from the 4 was 62,480 and 12 cents. And we went through that last night. So, perfect. Now, because it's 5 waves down and doesn't overlap, it could be an impulse. The thing is, really doesn't matter. Now that we've reached that target for the wave 5, we can stop arguing about whether it's an impulse or whether it's a diagonal and just call it a motive wave. Because that's what it is. Diagonals and impulses are motive waves rather than corrective waves. So what we've had is a motive structure down in the A. What we will get next is the corrective structure in the B. Multiple months of spring and summer while we move to a lower high, and then we'll have the crash down in the C, which will be another motive structure. Motive, corrective, motive. And that will bring about the end of the bear market in October this year. Whoop-de-doo. More cheap Bitcoin to come. Right. Now, that's the primary, and as Alex said, it doesn't have to be right, it's just the highest probability currently. If it changes, it changes. Now we move into the alternate. This is the one I mentioned at the start of the video from that prior video. Where was it? The one about something different. Is it a bear market or something different? Well, this one's very different. What this points to, guys, is a flat pattern. We've been in a bear market, not for a few months, but for over a year. It was a stealth bear market from January to now. January, and that was not to this January, that was January 2025. We came down in an A wave. We came up in a B wave, which did not go beyond the 1618 extension of the A, making it a legal B, and then we came down in that same motive structure of an ending diagonal rather than leading. In this case, meaning this isn't A down here, this is C, and this is 2. 1 here, 2 here. We have either got a little bit more work to do, or we've already bottomed. At this point, we're off to all-time highs. And this is where the most confusion is going to be caused. Because as I said earlier, if this one turns out to be right, everyone will say, oh, it wasn't a proper bear market. Yeah, it was, and it was a year long. It was totally typical. Right, nobody saw it. That's what makes it atypical. Why did nobody see it? Because of the same hubris I spoke to earlier that I'm guilty of. Every single prior correction we've witnessed in every single bear market has been a sharp pattern, not a sideways structure. Every single pattern has been a zigzag down, a sharp, no new price extreme. When we get a new price extreme, this structure of a flat is known as a sideways structure, not a sharp. It would be the first example in the history of this asset of a sideways structure in the wave 2 position at a large wave degree, and no one would have seen it coming. Now, I'm not picking it because it's exciting and different, although that does greatly appeal to me because of that. I'm picking it because probabilistically this is an absolutely perfectly valid way of looking at a correction. Expanded flat patterns are the most common sideways structures there are. You've got sideways combinations, running flats, regular flats, and expanded flats. And the expanded flat, and triangles, sorry, I forgot the triangle. Expanded flats are the most common. And this is a perfect expanded flat. 335. Doesn't break any rules. Goes beyond the 1618, that's fine. It can go to the 2618. Right, I don't think it probably will go that deep. It's like 32 grand or 34 grand or something. But as long as that fifth wave in the ending diagonal went beyond the length of the 3, we're cool. So we're right in the territory. Remember what I said earlier? We're on that monthly level. Monthly level, right in that little demand zone. Right in this volume node. We're in the and we're 50% pullback from the prior market lows. So if we go all the way back to the 2022 lows, sorry, excuse me, Freudian slip there. 2022 lows, and we look at the pullback for that move. Right, here's the demand zone, here's the 50% retracement, here's the 61% retracement. We are sitting right in the middle of what we call the target zone. Right, for a wave 2 pullback, it was a flat instead of a zigzag. That's going to catch everybody out. So to recap, based on all the confluent factors of the classical analysis and psychoanalysis combined, the primary Elliott Wave count is that we've done 5 down into an A, we will retrace in a B before coming lower in a C. The alternate is a surprise bear market, which is actually been ongoing for over a year, and it's almost at its completion, if not already at its completion, and it's going to surprise everyone, because it's going to confuse everyone. Okay? The final thing I want to cover is the possibility that we've had a brief bear market. That it's not A down, B back and C, but it's not A down, B back and C, but it's WXY and done. And it's short of an expectations. And that idea is this one. So, sorry. Not that one. This one. The one I just showed is an old idea I haven't deleted. We had 1 and 2 off for 22 lows, 3 and 4 for 22 lows, ending diagonal into 1. Then we come down in W, X and Y. Now if we come off of log, we can see that we've almost channeled perfectly. W, X and Y. But this could be A, B, C, W, A, B, C, X, and this could also be A, B, C, Y. So the 2 could already be in, or it could be over here a little bit later, around April, maybe May. Either way, significantly earlier than October. So it would be a briefer bear market, but it could already be done. So let's take the length of the W and project from the X to find the Y. What do we notice, guys? It's just below where we are. It's not a million miles away, not at all. But we could see potentially the A wave complete, the B wave come back, and then this final push down to that 1-to-1. But we don't have to hit it. We know we're in a strong support zone, and we know that we come back 50 to 61.8% into that demand zone. So this is the idea that we've had a very brief bear market. It's a tertiary idea, it's not primary alternate. I think it's less likely overall because all the confluent factors point to the time cycle analysis being correct. So that's it, guys. I don't think I've got anything else to discuss. I will just sign off by saying, as I've repeated multiple times, it's what you know for certain that just ain't so. That makes you wrong. Try not to be certain of anything, ever. Have conviction in things, but never be certain of anything, because that traps you. Puts the blinkers on and blinds you. And I genuinely am sincere warning, because I tried to get the word out for the gold and silver market a week before the top came in. I put a video out saying the top is coming, and was warning everybody that it was unsustainable, it was bound to turn around because all the narratives were so bullish, and I got a lot of flack for that at the time. I've had people come out and support me since, but it was the certainty that killed them and trapped them there. So always keep an open mind, always be flexible, and try and, if you are interested in owning Bitcoin, be simple in your thinking, and remember that 66,000, 67,000 it's just ticked over to, as I speak to you now, is a massive discount relative to 126,000. Don't try and time the market, focus on the price. If the market gives you more time to accumulate, don't whine and bitch about it, thank it. It's a blessing in disguise, and if everything plays out as it has done like clockwork up until this day, you will be rewarded for your patience. Alright guys, thank you very much for your time, and if you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you want to learn some Elliott Wave for yourself, and you want to learn how some trading techniques as well, risk management, things like that, get access to a public Discord, a whole raft of previous educational videos, as well as weekly updates every week for Bitcoin, gold and the SPY, occasionally oil and silver as well. I do that every week. All of those things and much more are available on my Patreon, and there's a link to there's a link in the description box below, so feel free to sign up. It's only going to cost you a tenner a month, and you can leave it anytime you like. Alright guys, take care of yourselves, and I'll be back with you as soon as I can. All the best. Bye bye.